A warm welcome to everyone. I am Sada Ul Ana. I'm here to discuss you with the topic commodity future trading. Likely most of you will be unfamiliar with this topic, but some of you might have drawn the meaning from the title itself. So what is commodity future trading? It's actually an experiment to buy a specific commodity at a specific time and date in the future at the specific cost. So commodity future trading was almost in a state of hibernation in our India for almost many decades, and it was recently changed by the various policy, institutional, and market activism. So in a prices of a commodities may changes on a weekly or even a daily basis. Since the cost is specified, in the future if the prices goes up, it's actually the good for the buyer, since he has to buy the commodity at the price that is already fixed, but the buyer has to may take it from the market at a much higher price, and vice versa. If the price goes down, the buyer has will face some loss, since the seller would buy at a lower price, and the buyer has to buy it with a specific cost that has already been fixed. So the most important changes that have been taken place in commodity future space in our India was the removal of prohibition on future trading in a large number of commodities and facilitating a modern demutualized exchanges by the government of India. These two initiatives together are becoming instrumental in changing the contours of the commodity futures markets in India in terms of both participation and the practices. So here's the list of the traded commodities. In agriculture products, there are various products that are such as corn, oats, rough rice, soya beans, meal, soybean oil, wheat, cocoa, etc. Then in case of livestock and meat, lean hogs, frozen pork bellies, live cattle, etc. Feeder cattle or energy. In bent crude, ethanol, natural gas, heating oil, Gulf Coast gasoline, etc. And also the precious metal that we already know: gold, platinum, palladium, silver, etc. So where are these exchanges? These where commodities are traded: the National Commodity and the Derivative Exchange, the Multi Commodity Exchange of India Limited, and the National Multi Commodities Exchange of India Limited. There are these three electronic trading and settlement system and a national presence. Apart from this, there is an Ace Derivatives and Commodity Exchange Limited, Bathinda Om and Oil Exchange Limited, and Universal Commodity Exchange in India. So what is the minimum investment that is required for this commodity future trading? The minimum amount is almost 5,000. All he needs is a margin payable upfront exchange through the brokers. The margins that is range from 5 to 10 percentage of the value of the commodity contract. The prices and the trading lost in agriculture commodities varies from exchange to exchange, but again, and the minimum fund required will begin only at the rate 5,000 only. So, how to start the trading? As of now, it just required a bank account, and also a separate commodity demat account from the National Security Depositor Limited to trade on NCDEX, just like in the stocks. So delivery or settlement in cash. Actually, we can do both of these. On these exchanges has both the system, cash and delivery mechanism. The choice is up to the individual who trades the commodities. If he wants to be in contracts as a cash settled, one has to indicate at the time of placing the order, and that he or she doesn't intend to deliver the item. If one plans to make the delivery, also this he must have required warehouse receipts, and the option to settle in cash or through delivery can be changed as many as times as one wants till the last day of the expiry of the contract. Regulators, as we know, if there is a game, there must have always be a court, referee to maintain the laws and orders of the game. This as the same in this exchange also, there are regulators. In actually these regulators are in forward market commission that seek to inspect the books of brokers if any foul practices are suspected. But this could change if the retail participation in commodities changes substantially. So the margin applicable, as in stocks, the commodity also margin is calculated by VAR system, that is value at risk. The margin is different at each commodity. Just like in equities, in commodities also, there is a system of initial margin and market to market margin. The margin keeps changing depending on the change in the price and the volatility. So that's it, friends. I hope you have thoroughly enjoyed the topic and understood what we have discussed now. So thanks all. Thanks.